I want to explain why I am looking at oil right now, not as a normal trade and not as a prediction that I know exactly what will happen next, but as a way to protect a portfolio against a kind of risk that most people are underestimating. That distinction matters. There are times when you buy an asset because you think it will go up. There are other times when you buy an asset because if it goes up, it probably means something else in your portfolio is under pressure. That second kind of position is a hedge, and a hedge is not supposed to be exciting. It is supposed to reduce the damage if the world moves against you. Most investors spend too much time asking, how much can I make? A serious investor also asks, what happens to the rest of my portfolio if I am wrong about the calmness of the world? Right now, the risk I am paying attention to is oil. More specifically, I am paying attention to the Strait of Hormuz. The Strait of Hormuz is one of the most important oil passages on Earth. Under normal conditions, roughly 1/5 of global oil supply moves through it. That is not a small flow. That is not a regional detail. That is one of the critical arteries of the global economy. If that artery is restricted, the entire body feels it. And what is happening now is not normal before the war. About 120 to 150 vessels could pass through the strait each day. Now, that flow has fallen dramatically down to something closer to 0 to 10 vessels a day in the source material. That is the kind of change that does not only affect oil traders, it affects inflation, it affects central banks, it affects corporate margins, it affects consumers, it affects airlines, shipping, manufacturing, food, chemicals, plastics, fertilizer, trucking, and almost everything that depends on energy moving through the global system. This is why I do not see oil as a narrow commodity story. I see it as a macro stress signal. The market is still treating this situation with more calm than I think is justified. That does not mean the market is stupid. Markets often look calm when buffers still exist. But buffers are not permanent. If the underlying supply problem keeps draining those buffers, the calm can disappear very quickly. The first principle is simple. Oil prices are a function of supply and demand. If supply falls sharply and demand does not fall enough, price must rise until demand destruction begins. That is not ideology, that is arithmetic. If the world needs a certain amount of oil every day and suddenly a large portion of that oil cannot move, then the missing barrels must be replaced, drawn from inventory, or eliminated through reduced demand. There is no fourth option in the source. Around 20 million barrels per Dalton Y normally move through the Strait of Hormuz. Some of that oil is still getting out through rerouting, pipelines, partial exports, and other channels. But the estimated disruption is around 12 million barrels. Per Dalton Y, 12 million barrels per Dalton Y is an enormous number. It is roughly 12% of global supply in the source S framing. It is also a larger supply shock than the 1973 oil crisis, which removed about 7% of supply. Whether the exact numbers move around day by day is less important than the scale of the problem. A few 100,000 barrels per Dalton Y can move the market. A few million barrels per Dalton Y can transform it. 12 million barrels per Dalton Y is a system-level event. That is why I am paying attention. Now, many people look at oil around $100 per barrel and think, if this were truly serious, oil would already be much higher. That is a reasonable question, but it misses the role of inventories. Oil prices have risen, but they have not yet gone to a panic level because existing inventories are acting as a buffer. Inventories allow the system to absorb shocks for a while. They make the shortage appear less immediate. They buy time. But buying time is not the same as solving the problem at the start of the year. Global oil inventories were around 8.4 billion barrels in the source material. That sounds like a huge number. And in one sense, it is. It includes commercial storage, strategic reserves, tank farms, refineries, terminals, floating storage, government stockpiles, and other inventories around the world. But the important question is not how much oil exists somewhere. The important question is how much oil can actually be drawn, moved, refined, and delivered to where demand exists at the speed required. Those are very different questions. Some inventory is strategic. Governments hold it for emergencies and will not necessarily release all of it. Some inventory is in the wrong place. Oil sitting behind a blocked route cannot solve a shortage elsewhere if it cannot move. Some inventory is not immediately usable because it needs to be refined. Some crude does not match the refinery system that needs it. Some oil can be released only at a limited speed because ships, ports, pipelines, trucks, storage systems, and logistics capacity are not infinite. People imagine inventory like a bank account. They think if there are billions of barrels stored, the market can simply withdraw them whenever it wants. But oil is physical. It has location. It has quality. It has transport constraints. It has refinery constraints. It has political constraints. It has release speed constraints. This is why the inventory number can mislead people. The source sites estimates that only around 800 million barrels may be realistically available, according to some analysts, while other estimates are higher, around 2.5 to 2.8 billion barrels. But even if you use a larger number, the problem remains serious. If 12 million barrels per Dalton Y are removed from supply, that is 1.2 billion barrels over 100 days. And the panic does not begin when the final barrel is gone. Panic begins when the market believes the buffer is becoming unsafe. Markets do not wait for physical exhaustion. They reprice when confidence in the buffer breaks. That is the danger. The visible price spike may still be only the first phase if the disruption continues. At the beginning of a supply shock, price rises in anticipation. If the actual shortage begins to bite, price must rise further to destroy demand. That means higher prices are not just a possibility, they may become the mechanism through which the system balances. When supply is missing, demand has to fall. How does demand fall? Consumers drive less. Airlines reduce routes or raise prices, companies cut activity, shipping slows fuel, intensive industries contract, households reduce discretionary spending because gasoline and energy costs eat more income. That is demand destruction. Demand destruction is painful. It does not happen because people calmly decide to use less oil. It happens because price forces them. That is why $100 per barrel may not be enough if the disruption continues. The source argues that $130 or even $150 may not be high enough to solve the imbalance. It also points out that in 2008, oil reached about $147 per barrel without a comparable supply disruption, and that adjusted for inflation, that price would be well above $200 today. I would not treat any price target as certain. But the reasoning is important. If oil reached those levels before without this exact shock, it is not irrational to consider that a major disruption today could push prices much higher. The market may not be pricing the tail risk aggressively enough because inventories still create the illusion of control. That is a common pattern. A system can look stable while reserves are being consumed. A household can look fine while spending savings. A company can look fine while borrowing to cover cash flow. A government can look fine while issuing debt. An oil market can look fine while inventories are being drained. The moment the buffer is questioned, the mood changes. This is why I prefer to think in systems rather than headlines. The headline says oil is above $100. The system says a major route is restricted. Supply is missing, inventories are being drawn down, and demand has not yet been forced low enough to clear the imbalance. That system can produce much higher volatility than the headline suggests. Now, why does this matter for stocks? Because oil shocks can crash markets. Oil is not just another commodity. It is embedded in the cost structure of the economy. When oil rises sharply, inflation pressure rises. When inflation pressure rises, central banks have less room to cut rates. When central banks have less room to cut, liquidity stays tighter. When liquidity stays tight, risk assets are more vulnerable. When gasoline and energy costs rise, consumers have less money to spend elsewhere. When consumers spend less, corporate revenue can weaken. When input costs rise, margins can shrink. When margins shrink, earnings expectations fall. When earnings expectations fall, stocks can reprice. That is the chain: oil shock, inflation, central bank pressure, consumer squeeze, margin pressure, earnings risk, market decline. This is why I am not looking at oil only as a profit opportunity. I am looking at oil as a hedge against a stock market crash. I do not want to sell all my long-term positions. I still believe in long-term investing. I do not want to sell the S&P 500, gold, silver, metals, or other long-term positions just because there is a risk event. But I also do not want to pretend that a portfolio cannot be damaged by a 20-25 or 30% drawdown. If an oil shock becomes severe, a hedge is a way of saying, I want to stay invested, but I do not want to be completely exposed to one scenario. If oil spikes and stocks fall, an oil position may rise at the same time that stocks are under pressure. That gain may reduce the portfolio drawdown. If the portfolio would have been down 25%, maybe it is down 10%. If it would have been down 20%. Maybe it is down 5 or 8%. Those differences matter psychologically and financially. They allow you to avoid panic. They allow you to rebalance. They allow you to use gains from the hedge to buy assets that have fallen. That is the real purpose. If oil rises because the crisis worsens and stocks fall, the oil hedge can create cash or profits that can be redeployed into the dip. That is a much better position than being forced to sell stocks at a loss or watch the whole portfolio fall without any offset. This is the logic of portfolio construction. You do not own only the assets you love. You own assets that behave differently under different conditions. The world is uncertain, therefore the portfolio must not depend on one future. Now, I want to be very clear, this is not a risk-free trade. Oil can fall. The biggest risk is de-escalation. If the conflict cools quickly, if the Strait of Hormuz reopens, if tankers resume normal flow, if insurance becomes available again, if military tension declines, if supply returns, then the oil price can fall sharply. That is the other side. Every hedge has a cost. If you buy insurance and the house does not burn down, the premium feels wasted. But that does not mean the insurance was irrational. It means the bad event did not occur. A hedge is not judged only by whether it makes money. It is judged by whether it protects the portfolio from a scenario that could have caused serious damage. This is why position size matters. If you make the oil trade too large, it stops being a hedge and becomes speculation. If you make it too small, it may not protect the portfolio enough. The correct position size depends on the rest of the portfolio, the investor's risk tolerance, the probability assigned to the shock, and the expected correlation between oil and the assets being hedged. I am not making a wild all-in bet. That would be bad risk management. I am positioning in a way that can help protect the broader portfolio if the oil shock worsens. That is the point. Now let us talk about why the situation is difficult to resolve. Some people think the United States can simply force the strait open militarily in pure military terms. The United States is much stronger than Iran. That is obvious. But markets do not price only who is stronger. They price cost, duration, disruption, retaliation, infrastructure risk, insurance risk, and uncertainty. A strong military can still face a messy conflict when the geography is difficult, and the weaker side can create damage through asymmetric means. The source uses a useful analogy: a lion fighting a porcupine or a honey badger. The lion is stronger, but the fight is still costly. In the Gulf, the issue is not only whether the strait can eventually be reopened, the issue is what happens during the attempt. If the United States or others try to force the strait open and Iran retaliates by striking oil infrastructure in the Gulf, then reopening the route may not immediately solve the problem. Producers may have less oil to export if infrastructure is damaged. Ports, terminals, refineries, pipelines, storage facilities, and other energy infrastructure can become targets or risk zones. That is why the situation is structurally dangerous. It is not a simple switch: closed or open, war or peace, oil flowing or not flowing. The real system is messier. Even partial disruption can change insurance rates. Higher insurance costs can make shipping uneconomic. Fear of seizure or attack can reduce tanker traffic. Rerouting can add cost and delay. Pipelines can offset some flow, but not all of it. Strategic reserves can help, but not forever. Inventories can buffer, but not replace normal supply indefinitely. This is why I do not dismiss the risk just because oil has not exploded to a record high yet. A market can underreact until it suddenly overreacts. The underreaction often comes from the belief that the situation will resolve before inventories become critical. Maybe it will, but if it does not, the repricing can be violent. That is what hedges are for. Now, let us think about oil inventories as a balance sheet. A company with a large cash balance can absorb losses for a while. If the losses continue every month, the cash balance declines. At first, outsiders may say, there is plenty of cash. Then one day, they realize the burn rate is too high. The confidence breaks before the cash is actually zero. Oil inventories are similar. The world may have billions of barrels in storage, but if accessible barrels are limited and 12 million barrels per Dalton Y are being removed from normal flow, the burn rate becomes the story. The stockpile number matters less than the drawdown speed. This is true in many systems. Debt matters, but debt service matters more. Cash matters, but burn rate matters more. Inventory matters, but drawdown matters more. In oil, the drawdown speed is dangerous. That is why the buffer can become fragile quickly. Now, what happens if oil rises much further? First, inflation expectations may rise. Second, bond yields may respond. Third, central banks may become more cautious. Fourth, consumers may pull back. Fifth, corporate earnings estimates may be revised lower. Sixth, equity valuations may compress. Seventh, risk appetite may fall. Eighth, assets that benefit from inflation or commodity strength may outperform. This is not guaranteed in a straight line, but it is the logical chain. That is why an oil position can serve as an offset against a stock-heavy portfolio. If oil falls because the war ends, then the oil hedge may lose money. But the rest of the portfolio may benefit from lower inflation risk, lower energy costs, better sentiment, and relief in equities. That is the trade-off. In a good hedge, you may not win on every piece at once. That is normal. If oil goes down because the crisis ends and stocks rally, the hedge loses, but the core portfolio wins. If oil goes up because the crisis worsens and stocks fall, the hedge wins while the core portfolio is protected. That is the purpose. Many retail investors misunderstand this. They want every position to go up at the same time. That is not true portfolio construction. True portfolio construction means some assets should work in environments where other assets struggle. You do not want perfect correlation across everything you own. If everything rises together in good times, everything may fall together in bad times. That is not diversification. That is concentration disguised as variety. Oil, in this specific environment, may have a different relationship to the rest of the portfolio because the same event that could push oil higher could pressure stocks lower. That makes it interesting as a hedge. Now, I want to emphasize the difference between investing in oil and investing in oil companies. The source focuses on oil as a market exposure, but there are several possible instruments you can invest through oil. Related ETFs, you can invest through energy equities, you can invest through futures-based products, you can invest through producers, refiners, service companies, or broad energy funds. Each behaves differently. Oil futures exposure can be complicated because of roll costs, contango, backwardation, and product structure. Energy stocks may not track oil perfectly because companies have hedging, costs, debt management decisions, political risk, and equity market correlation. Producers may benefit from high oil prices, but if the stock market crashes, their share prices can still be volatile. Refiners may behave differently because crude price is an input and refined products are outputs. Broad energy funds diversify company risk but still have sector risk. The instrument matters. A hedge only works if you understand what you actually own. Do not buy something merely because it has oil in the name. Study the structure. Study how it responded in prior oil shocks. Study whether it tracks spot oil, futures, energy equities, or something else. Study liquidity. Study fees. Study risks. The thesis can be right and the instrument can still be wrong. That is an important principle. Now, what would make me wrong? A rapid ceasefire or de-escalation, a credible reopening of the strait, a decline in insurance risk, a resumption of tanker traffic, a major coordinated strategic reserve release that meaningfully calms the market, a faster rerouting solution than expected, demand destruction already occurring at lower prices than expected, a global economic slowdown that reduces oil demand sharply. All of those can hurt the oil thesis. This is why I would not treat the position as a certainty. It is a probability-weighted hedge. The situation may worsen. It may also improve. A serious investor thinks in probabilities and consequences. What is the probability of disruption continuing? What is the consequence if it does? What is the consequence if it resolves? How much protection do I need? How much am I willing to lose if the hedge is not needed? Those are the right questions. Now, let us look again at the market psychology. The reason oil is not already at a panic price may be that people are using recent price behavior as evidence that the system is okay. Oil has moved up, but not enough to shock them. Stocks have not fully collapsed. Inventories still exist. Some exports still move. Governments may intervene, the market says. Maybe this will pass, and it might. But the danger in markets is that a price can stay calm until the probability distribution changes suddenly. A tanker incident, a failed negotiation, a military strike, a refinery attack, a sharp inventory report, a government statement, an insurance withdrawal. Any of these can change expectations fast. Commodity markets can move violently when physical constraints become obvious. This is why the time to think about a hedge is before the panic is fully priced. If you wait until oil is already at a panic price, the hedge may be expensive and the risk-reward may be worse. That does not mean buy blindly today. It means the analysis must happen before the headlines become extreme. Now, I want to talk about the emotional side of hedging. A hedge can be frustrating. If the bad event does not happen, the hedge may lose money or underperform. People then feel stupid for having bought protection. This is a misunderstanding. If you insure your house and it does not burn down, you do not say the insurance was stupid. You say the bad event did not happen. The same logic applies to a portfolio hedge. The correct question is not, did the hedge make money in isolation? The correct question is, did the hedge improve the risk profile of the whole portfolio given the uncertainty I faced? That is how professionals think. They judge positions by role. A growth stock has one role, a bond has another, gold has another, cash has another. Oil in this situation can have another. Role clarity prevents emotional mistakes. If you buy oil as a hedge and then become angry that it did not act like a growth stock, you misunderstood the position. If you buy oil as a speculation and then pretend it was a hedge after it falls, you are lying to yourself. Know the role before buying. Now, how does this fit with long-term investing? Long-term investing does not mean doing nothing while major risks develop. It means you do not abandon your long-term plan because of short-term fear. A hedge can help you stay with the long-term plan if you know that part of your portfolio may benefit from an oil shock. You may be less likely to panic sell your core assets. That is one of the hidden benefits. Hedges are not only about dollars, they are about behavior. A protected investor behaves better. An unprotected investor under stress may sell the wrong thing at the wrong time. If an oil hedge gives you the confidence to keep holding your core positions through volatility, it may have value beyond its direct return. That is why portfolio design is deeply connected to psychology. The best portfolio is not just the one with the highest expected return. It is the one you can actually hold through the environments you are likely to face. Now let us consider the stock market crash risk more directly. If oil rises sharply because of a supply shock, the stock market can be hit from multiple directions. Energy costs rise, margins compress, consumers pull back. Inflation expectations rise, the Fed becomes constrained, discount rates may stay higher, credit conditions may tighten. Geopolitical risk premium rises, investor sentiment weakens. This can affect broad indices, especially if valuations are already high. The S&P 500 can fall even if many companies are strong, because the macro discount rate and earnings outlook change. That is why oil matters to equity investors. You do not need to own energy stocks to be exposed to oil. If you own the stock market, you are exposed to oil through the economy. That is a key point. Energy is an input into many businesses and into household budgets. When a critical input spikes, the whole system must adjust. Now, why not just sell stocks and wait? Because selling everything creates a different risk. The war may end, oil may fall, stocks may rally. If you sold everything, you may miss the recovery. Then you face the difficult emotional choice of buying back higher. This is why hedging can be better than abandoning the portfolio. It allows participation in the long-term upside while reducing damage from a specific risk. That is a more balanced approach. All-in and all-out decisions are often emotionally satisfying but structurally poor. The world is uncertain. The portfolio should reflect that. Now, let us bring the inventory issue back one more time because it is central. The market is not panicking because inventories are still acting as a shock absorber. But if the shock absorber wears down, the ride gets much rougher. The source makes the point that if inventories are being drawn down at 12 million barrels per Dalton White, the system can burn through enormous amounts in a short period, and the market will not wait until reserves are empty. It will react when inventory levels approach a psychologically and operationally uncomfortable threshold. We do not know the exact threshold. That uncertainty itself is part of the risk. When the market does not know exactly how close the buffer is to failure, it can move suddenly. Confidence breaks and jumps. This is true in banking. It is true in sovereign debt. It is true in corporate liquidity. It is true in commodities. Markets can be calm until they are not. That is why the phrase, largest oil supply shock, matters. It is not a label for drama. It is a reminder that the scale of the missing supply may be larger than what many investors are pricing. Now, if the disruption continues, where could prices go? The source suggests that oil can go above $150 easily if the war drags on and the strait remains restricted. It also suggests that inflation, adjusted comparisons to the 2008 peak, would imply prices well above $200. I would not make a portfolio depend on a single price target. Price targets create false precision. But I would say that the upside tail is meaningful. When a physical commodity is constrained and inventories are declining, price can move farther than people expect because the market must force real-world behavior to change. It must destroy demand. That is not a normal valuation process. A stock can be too expensive and remain too expensive for a long time. A commodity shortage is different. If the physical system cannot supply enough units, the price must keep moving until the shortage is resolved or demand falls. That is why commodity shocks can be violent. Now, what should an investor avoid? Do not confuse this with a guaranteed trade. Do not over-leverage. Do not put money into oil that you cannot afford to see decline. Do not ignore the possibility of de-escalation. Do not chase after a vertical move without a plan. Do not use instruments you do not understand. Do not let a hedge become an oversized speculation. Do not assume that because oil may rise, every oil-related security will rise the same way. Do not forget taxes, fees, liquidity, and product structure. Do not become emotionally attached to the thesis. If the facts change, the position must be reviewed. A good hedge is dynamic. It is not a religion. Now, what would I watch? Tanker traffic through the strait. Insurance availability and pricing statements from Iran and the United States, reports on Gulf infrastructure risk, pipeline rerouting capacity, inventory drawdown data, strategic reserve releases, WTI and Brent price behavior, the reaction of inflation expectations, bond yields, equity market breadth, energy sector relative strength. If tanker traffic normalizes and inventories stabilize, the hedge thesis weakens. If traffic remains near 0 to 10 vessels a day, inventories continue to draw down, and oil pushes higher, the thesis strengthens. If oil rises while stocks begin to weaken, the hedge is doing its job. If oil falls because the crisis resolves and stocks rally, the hedge is no longer needed in the same way. This is how to monitor the position, not emotionally, mechanically. Now, there is a larger lesson about risk. Most people think risk is volatility. They think a stock moving up and down is risk. Volatility is one form of risk, but the deeper risk is being structurally exposed to one scenario without realizing it. If your whole portfolio depends on low energy prices, calm geopolitics, falling inflation, and easy monetary policy, then you are exposed to a scenario where oil shocks the system. You may not see that exposure on a brokerage statement, but it is there. A hedge is a way of admitting uncertainty, it says. I believe in my long-term positions, but I also recognize that the world can produce shocks. That is mature investing. It is not fear. It is respect for reality. Now, the source is forceful because it believes the market is underestimating the situation. I understand that view when a critical route carrying a large portion of world oil supply is disrupted, when 12 million barrels per Dalton Y may be missing, when inventories are being drawn down, and when prices have not yet fully adjusted to a panic scenario. The setup deserves attention, but I would frame it with discipline. The thesis is not oil must go up. The thesis is oil has asymmetric upside if the disruption persists, and that upside may offset losses elsewhere in the portfolio if the shock causes a broader market sell-off. That is a much better thesis. It identifies the condition if the disruption persists. It identifies the payoff. Oil may rise sharply. It identifies the portfolio role. Offset equity damage and create dry powder. It identifies the risk de-escalation can hurt the position. That is clear thinking. Now, what does this mean for someone who is not a trader? It means you should not ignore oil, simply because you are a long-term investor. You do not have to trade oil actively. You do not have to make oil a major position. But you should understand how oil shocks affect the assets you already own. If you own broad stock ETFs, your portfolio is connected to oil through inflation, interest rates, and earnings. If you own bonds, oil can affect inflation expectations and yields. If you own gold, oil shocks can affect the inflation and geopolitical risk narrative. If you own cash, inflation affects real purchasing power. If you own real estate, energy and rate shocks can affect affordability and financing. Everything is connected. Oil is one of the connection points. That is why macro matters, not because you need to predict everything, because you need to know which risks can affect multiple parts of the system at once. A major oil shock is one of those risks. Now, how should you think about action first? Evaluate your portfolio. Are you heavily exposed to stocks and growth assets? Do you have any assets that could benefit from an inflationary commodity shock? Do you have cash to buy dips? Are you over-leveraged? Do you have emergency reserves? Second, study oil exposure instruments before buying anything. Understand whether the instrument tracks spot oil, futures, energy equities, or producers. Third, decide whether the position is a hedge or a speculation. If it is a hedge, size it based on the protection needed, not on the dream of maximum profit. Fourth, set rules. What happens if the strait reopens? What happens if oil spikes to a target area? What happens if stocks fall sharply and the oil hedge gains? Do you take profits and buy the dip? Do you reduce the hedge if de-escalation begins? Rules prevent emotional decisions. Fifth, monitor the actual physical situation. Do not monitor only the price. The price is the symptom, the supply route, inventory drawdown, and geopolitical risk are the disease. You must watch the cause, not only the symptom. Now, I want to finish with the principle that matters most. The goal is not to be right about oil for ego. The goal is to protect the portfolio and keep the ability to act. If the war ends and oil falls, I would prefer that outcome if it means the rest of the portfolio continues rising and the world becomes more stable. If the war worsens and oil spikes, then the hedge may protect against broader losses and provide capital to buy assets that become cheaper. Both scenarios can be handled if the position is sized correctly. That is the purpose of a system. You do not need the world to unfold in only one way. You prepare for more than one path. A fragile portfolio needs the best case. A resilient portfolio can survive several cases. That is what I want. The Strait of Hormuz disruption is not normal. The potential loss of millions of barrels per Dalton Y is not normal. The inventory buffer being drawn down is not normal. The possibility that oil must rise high enough to force demand destruction is not normal. And the stock market may not be fully pricing that risk. So I am paying attention. I am not abandoning long-term investing. I am not making a reckless bet. I am using oil as a hedge against a specific macro shock that could damage equities, raise inflation, constrain the Federal Reserve, and create a broader market decline. That is the logic. No hype, no certainty, just supply, demand, inventories, risk, and portfolio protection. That is how I would think about oil right now.